Nike's turnaround taking longer than expected, or I should say will take longer than expected under the company's new CEO, Elliott Hill. The company outlined a plan to liquidate old inventory through less profitable channels to try to move away from promotions and return to full price models. That's the attempt, at least. As a result, Nike expects margins to be down between 3 to 3.5% during the holiday quarter. Joining us right now to talk about this is John Kernan. He is a managing director and retail analyst at Cowen. There's been a lot of excitement about this new CEO and potentially the direction of the company. How much of this is just going to be the growing pains and you got to see through this?
Yeah, good morning, Andrew. Thanks for having me. Look, Elliott's a 30-plus year veteran at Nike. He will bring the brand back to a much more competitive position against peers, but he's setting a very low bar for his own expectations and the street's expectations initially as they reset the marketplace. So a lot of pressure on this financial model.
So, I mean, are you happy or upset that the bar is this low?
We've been cautious on Nike for the better part of a year. We've favored some of their competitors like Deckers, which owns Hoka, and On, which was our top idea coming into the year. It's very difficult to pin down where the bottom in the company's operating margin is going to be the next 2 years, given the pressure on gross margin. You mentioned how much inventory they have to clear. Their gross margin is going to be down over 300 to 400 basis points in the back half of this year. The problem with that is they promote this heavily to clear goods. It's going to be a long road back to full price as they start to reintroduce newness into the marketplace.
How much of it is about just getting back to full price versus getting back to innovation? Meaning, when you talk about Hoka, when you talk about On, when you talk about some of these other sneaker companies that have had such great success, part of it is that there's a view that there's been more innovation there.
There has been, certainly at the premium level. If you look at the average selling prices of Hoka and On right now, they continue to rise year over year. Their full price sell-through levels remain very high, and it's just based on innovation. It's silhouette innovation, it's materials innovation. Their marketing has been very fresh, and that is exactly what Nike has lacked. Nike's been backed into a corner. I think they're a bit too focused on basketball right now. They've lost ground in lifestyle and running in a lot of key categories, and it's not just footwear they're losing share in. They're losing a lot of share in apparel, too, at the high end to smaller upstarts.
And so what has to happen to fix that? And do you believe this new CEO can do that?
Yes, I think Elliott will certainly, he's going to refocus the company's strategy on the wholesale channel. They're going to go back to, I think, the playbook that worked for them in the early 2000s and mid 2000s, really up to when John Donahoe came and made a huge focus on the direct-to-consumer channel, which was a mistake. They also lacked innovation. They've got to get better design. They've got to get better marketing, and they've got to reacquire consumers that they have lost to peers. The pie only grows so fast in this industry. So if On, Hoka, New Balance, Adidas, all of them, they all keep growing at the rate they're growing, it's going to be difficult for Nike to reacquire consumers in a lot of these categories where they've lost share.
What do you think the fair value of this company is? We're looking right now, it's about $74, call it, $75?
Our price target $69 for what that's worth. We use a variety of valuation metrics. We run DCFs, and we run, we look at relevant valuation like PE and EV to EBITDA. If you build just a basic DCF on this business, you have to assume it gets back to at least a mid to high single-digit top-line growth rate over the next 5 to 10 years. You just assume its operating margin gets back to 15% or so, which is only really hovered around for short periods of time. This has been a cyclical business the last 5 years, and we think the shares don't offer much upside from here, and we would continue to play the peers here that are gaining market share.
I mean, that's even after the stock's down more than 30% for the year.
It's been a shocking change in the economics of their business, Becky, that the margin profile of the business and the lack of top-line growth and the need to reinvest has really changed. What we thought was going to be a high teens EBIT margin business is now sitting sub 10% this year, maybe closer to 8%. It's going to be a long road back to that 13% or so EBIT margin that they generated for a long time. Again, expectations are low, and Elliott's probably setting a low bar. This is one of the most powerful brands in the world, one of the most recognizable brands in the world when it comes to sport. But right now, if you just stay true to numbers and the financial model, the shares don't look cheap on the next several years.
What's the fair price that you would say, okay, all of a sudden this does look good?
I think you need to see more downside. You look at consensus estimates for EPS next year. I think that You can make an argument that $2 in EPS for fiscal 25 is fair. I think there's going to be pressure in early fiscal 26. That's going to make it put a lot of pressure on the back half of fiscal 26 to show growth on both the top line and margin expansion. I don't think you're back to $3 in earnings before fiscal 27. I don't see why you need to pay 30 times earnings for that, far out of earnings. And that's what would get you meaningful upside from here.
Which translates to a price right now in the stock. What price would be attractive in the stock?
I'd like to see it go down another 15 to 20% before it became attractively valued for us.